There is a building in Chicago's Gold Coast neighborhood, one of the most prestigious residential addresses in America, that Ken Griffin no longer calls home. At some point in the years before 2022, 25 bullet holes appeared in its facade. 25. Griffin, the founder and CEO of Citadel, the most profitable hedge fund in American history, looked at those bullet holes and made a decision. He was done. He packed up his family, reorganized one of the world's most powerful financial institutions, and moved to Miami. The Windy City lost a $65 billion hedge fund, more than 1,000 high-paying jobs, and a billionaire whose estimated net worth had climbed past $35 billion. It did not get a single bullet hole back. This is a story about that decision, what drove it, what it triggered, and what it reveals about the accelerating reordering of American financial geography. Because Citadel's move was not simply one billionaire voting with his feet. Part 1. The making of a breaking point. Ken Griffin founded Citadel in 1990 in Chicago. He was 21 years old, trading convertible bonds from his Harvard dorm room, and smart enough to know that Chicago, the city of the Board of Trade, of commodity pits, of a financial infrastructure that stretched back to the Civil War era, was a serious place to build a serious firm. For 32 years, that calculation held. Citadel grew from a small multi-strategy fund into a financial colossus. By 2022, it managed approximately $65 billion in assets across equities, fixed income, commodities, quantitative strategies, and credit. Its market-making arm, Citadel Securities, executed roughly 25% of all U.S. equity trades on any given day, more volume than the New York Stock Exchange, and all of it was headquartered in Chicago. Then, in 2021 and 2022, something changed. It did not change overnight, and it did not change for a single reason. The decision that Griffin announced in June 2022, in a letter to employees describing Miami as a city rich in diversity and abounding with energy, that was the product of a slow accumulation of grievances, compounded by pandemic-era experiences that reordered the priorities of virtually everyone in finance. The crime argument gets cited first, and it is not manufactured. Chicago's homicide rate had climbed steadily from 2016 onward, peaking at 797 murders in 2021, a number not seen since the mid-1990s. Griffin had watched colleagues have bullets fly through their cars. This was not rhetoric. This was operational reality for a firm that was trying to recruit the best portfolio managers, traders, and technologists on the planet. The tax structure added pressure. Illinois imposes a flat state income tax of 4.95%. Combined with the Chicago City income tax of 5% for residents, the effective burden on high earners exceeded 7% in state and local taxes alone. Florida imposes no state income tax whatsoever. For a portfolio manager earning $5 million per year, that is a swing of $350,000 or more annually. "It's going to get me thrown out of here," he said. "But taxes weren't part of our decision to come to Florida. What mattered," he argued, "was quality of life. Schools, safety, environment." He was, in effect, making a more damning argument than the tax one. He was saying Chicago had become a place where talented people simply did not want to live. There was also a pandemic-era scientific rationale that has received less attention but deserves more. Griffin revealed at the Futures Industry Association's annual gathering that Citadel had conducted research in 2020 suggesting that viruses are less transmissible in high humidity, high sunlight environments. They laid out a map. South Florida emerged as the logical destination for business continuity planning. Within months, Citadel signed a lease for approximately 95,000 square feet at 830 Brickell. At that point, still under construction, the most anticipated office tower in Miami's history. The lease was priced in the range of $110 to $125 per square foot annually, representing a commitment of roughly $10, $5 to $11, $4 million per year. 830. Brickell opened in October 2024, a 57-story, 724-foot glass tower designed by Adrian Smith and Gordon Gill Architecture, the firm behind the Jeddah Tower in Saudi Arabia. It is, as of this writing, the tallest office building in Brickell. By the time it opened, it was fully leased. Over 90% of its tenants had moved from major markets, New York, Los Angeles, or Latin America. By any measure, this is not a temporary outpost. Citadel is building a monument to its Miami commitment. Griffin's headcount projections from 2022 called for 400 to 500 people in Miami by the end of that year. As of October 2025, he confirmed in New York at Citadel Securities' Future of Global Markets conference that Chicago had been reduced to a few hundred employees from its peak of 1,300. Most of the firm's talent has migrated to Miami and New York, which Griffin now treats as co-primary hubs. Chicago, he noted, would occupy just 2 floors of one of its tallest remaining skyscrapers. The city that hosted Citadel for 32 years had become a footnote in the firm's operational geography. Part 3. The Accelerant. What Miami became. Griffin's decision did not take place in a vacuum. He arrived in a city that had already been transformed by an earlier wave of migration, and his arrival in turn accelerated a second and then a third. Barry Sternlicht's Starwood Capital Group, a $115 billion investment firm, pioneered the move in 2018, relocating from Greenwich, Connecticut to Miami Beach. Carl Icahn moved Icahn Enterprises from New York to Sunny Isles Beach in early 2020. Elliott Management, the Paul Singer-founded activist hedge fund, relocated from Manhattan to West Palm Beach the same year. These moves predated Citadel's and planted the institutional infrastructure, law firms, prime brokers, talent pools, private schools, that makes relocation viable for major financial organizations. After Citadel arrived, the dam broke. Between 2024 and 2025 alone, more than 30 major corporations either relocated headquarters to South Florida or significantly expanded operations there. The list reads as follows. Blackstone, the world's largest private equity firm, expanded its Miami investment and real estate operations. Goldman Sachs expanded its Palm Beach County footprint, adding more than 100 traders and sales representatives in West Palm Beach. Point 72. Asset Management expanded its Miami and Palm Beach offices to support trading and investment teams. Millennium Management, Citadel's direct rival in the multi-strategy hedge fund space, maintained a growing Miami presence. Microsoft established its Latin America regional headquarters at 830 Brickell. Amazon signed the largest office lease in Wynwood history, 75,000 square feet at Wynwood Plaza in 2025. Palantir announced in February 2026 that it was relocating its headquarters to Miami, with co-founder Peter Thiel simultaneously expanding his Founders Fund presence in the city. The financial data capturing this transformation is striking. Florida captured 11% of all new U. Hedge fund launches in 2024, up from 3% in 2020. More than 500 money management firms are now headquartered in Florida, collectively managing approximately $300 billion in assets. The state's financial services private fund advisor exemption, enacted in October 2024, eliminated annual audit requirements for smaller funds and reduced compliance costs by an estimated $200,000 to $500,000 annually per firm, a structural regulatory advantage that New York cannot replicate without Albany's cooperation. Miami's broader population dynamics were accelerating in parallel. Florida's Office of Economic and Demographic Research projected in a June 2025 report that the state's population would surpass 24 million by 2027 and reach 27 million within the following 14 years, averaging more than 200,000 new residents per year. This was not a boom. This was a structural demographic shift of the kind that rewrites the political and economic map of a country. Part 4. Who's next? The New York question. Here is where the story shifts from historical document to live news, because the question of who follows Citadel is no longer theoretical. It is happening in real time, and it is being driven by a political variable that Citadel's original move did not include. On November 4th, 2025, Zoran Mamdani, a Democratic socialist who had served in the New York State Assembly, won the New York City mayoral election. He took office on January 1st, 2026. His central campaign pledge on taxation was simple and unambiguous. Raise the city's top income tax rate from 876% to 9%, combined with New York State's top marginal rate of 9%, which already applies to incomes above $25 million. Mamdani's proposed combined rate would reach approximately 8% for New York City's wealthiest residents. Florida's combined rate, 0. The immediate reaction from the financial community was loud. Hedge fund billionaire Bill Ackman stated that businesses and wealthy residents have already started making arrangements for the exits. Andrew Cuomo, Mamdani's opponent in the Democratic primary, joked that if Mamdani's plan became law, even I will move to Florida. John Katzimatidis, the billionaire owner of the Gristades supermarket chain, told the Free Press he might consider closing our supermarkets and selling the business. Griffin himself weighed in, telling the America Business Forum in late 2025 that he hoped Mamdani would govern differently than he campaigned, that the people of New York deserve better. The most concrete corporate signal came from Apollo Global Management, which manages approximately $650 billion in assets and has long been headquartered in New York. Reports emerged in early 2026 that Apollo was planning to establish a second headquarters in either Florida or Texas, citing Mamdani's tax posture and the broader policy direction of the Mamdani administration. IRS migration data covering the period from May 2024 through October 2025 found that over 5,500 high-income taxpayers left New York City, with movement concentrated in states with no income tax. In the earlier period between 2020 and 2024, 892 companies left New York. taking with them an estimated $47 billion in taxable income. Florida captured 341 of those moves, the most of any destination state. Griffin's proposed pied-à-terre tax went further still. On April 15, 2026, Mamdani stood outside 220 Central Park South. The Manhattan building where Griffin owns a penthouse purchased for $238 million, pointed at the camera and declared that the city was taxing the rich. He named Griffin by name. He listed the address. He used the private residence of a U.S. citizen as a campaign prop. Citadel's COO, Gerald Beeson, responded with an internal email noting that the firm was moving forward with the development of 350 Park Avenue, a New York project expected to generate 6,000 construction jobs. The message, unstated but legible, was that Citadel was not retreating from New York entirely. But it was watching, and it was not impressed. The data on whether high earners actually move in response to tax increases is more nuanced than the political debate suggests. A 2016 Stanford University and Treasury Department study examined tax records for all million-dollar earners over 13 years and found that tax flight occurs only at the margins of statistical and socioeconomic significance. A 2023 Fiscal Policy Institute study found no statistically significant evidence of tax migration following a 2021 New York State income tax hike. And in the first quarter of 2026, Manhattan's commercial real estate market surprised observers with rising rents, falling vacancy rates, and strong AI company leasing activity. Nscale Global Holdings signed at One Vanderbilt at $320 per square foot, a record. New York, as its defenders correctly point out, remains indispensable, but the margins matter enormously when the individuals at those margins are worth hundreds of millions of dollars each. The Tax Foundation's Jared Walczak put it precisely. The city won't empty out if taxes rise, but on the margin, you expect some people to move. That hurts the city and the state because these individuals are already paying a lot of taxes and creating a lot of jobs. New York's share of American millionaires fell from 7% in 2010 to 7% in 2022, a decline equivalent to more than $13 billion in potential annual tax revenue. In 2023 alone, New York registered a net loss of $10. $7 billion due to interstate migration, second only to California. Part 5. Dallas and the Global Dimension. Miami is the most visible destination, but it is not the only one. The restructuring of American financial geography has a second center of gravity, Texas, and specifically Dallas-Fort Worth. The numbers are startling. Data compiled in 2024 found that Texas had 519,000 financial sector employees, surpassing New York State's 507,000 for the first time. J.P. Morgan Chase now employs more people in Texas than in New York, with a Texas headcount of over 30,000 compared to fewer than 29,000 in New York, down from 35,000 in recent years. Goldman Sachs is constructing a $500 million, 800,000 square foot campus in Dallas, expected to house more than 5,000 employees by 2028. Wells Fargo has made similar investments in the Dallas-Fort Worth corridor. In early 2026, NYSE Texas launched in Dallas, relocating what had been a 143-year-old Chicago trading operation to the Lone Star State. The Texas Stock Exchange, backed by more than $160 million from major investment firms, is scheduled to begin trading by the end of 2026. NASDAQ has announced plans for a third Texas exchange. 3 major stock exchanges operating simultaneously in Dallas is not a trend. It is an ecosystem. The cost arithmetic is stark. In the first quarter of 2025, average asking rent for premium office space in Dallas-Fort Worth was $22.15 per square foot. In Brickell, the market rate was roughly $100 per square foot. In Manhattan, it exceeded $150 for Class A space and $320 for the most coveted addresses. Borders. Dubai has emerged as an unexpected third node in this migration. The Dubai International Financial Center registered 102 hedge funds in December 2025, with 81 of those managing more than $1 billion each, and posted a 28% increase in company registrations for the year, with 1,924 new firms establishing operations. Total assets under management at the DIFC surpassed $700 billion in 2025. The roster of 2025 arrivals included Baron Capital Management, Bluecrest Capital, Oak Hill Advisors, Select Equity Group, and Silverpoint Capital. Henley and Partners projected that 9,800 millionaires relocated to the UAE by end of 2025, the highest net inflow of affluent individuals of any country in the world. The DIFC's zero tax for 50 years policy, established in 2004, means that personal income, corporate income, and capital gains face zero taxation, a regime that makes even Florida look comparatively expensive. 8% creates savings of approximately $2, $2 million per year for every $15 million earned. Dubai's 0% versus New York's 14%, 8% roughly doubles that advantage. Ken Griffin's move from Chicago to Miami was never simply about crime or taxes or the weather. It was the culmination of a decades-long divergence between what governing coalitions in high-tax, high-cost urban centers were delivering in terms of public safety, quality of schools, regulatory predictability, and political stability, and what the people who manage large pools of mobile capital required in order to remain. The decisions being made now, in 2026, as New York's new mayor proposes combined income tax rates approaching 17%, as Dallas builds 3 simultaneous stock exchanges, as Dubai records 800 new millionaire arrivals in a single year, are not cosmetic. They represent a structural realignment of where financial power operates, where it recruits, and where it reinvests. Senior New York hedge fund professionals, many of them now in their 50s and waiting only for their children to finish school, are telling recruiters they plan to move south once those obligations lift. A veteran hedge fund recruiter who spoke to eFinancial Careers in November 2025 put it plainly, these are executives who came up through banking and the multi-strategy hedge fund boom who are open to relocating the moment family obligations ease. And there is a quality of life argument that is increasingly hard to dismiss. Miami's violent crime rate has fallen significantly as the city has invested in public safety under successive mayors. Griffin has noted the contrast explicitly. If I look at Miami and why it is so successful, the focus on education, the focus on public safety, these are safe streets. We live in a safe city. One financial executive who relocated from New York to Dallas and was quoted in the New York Post made a remarkable statement. He had heard of people who made the New York to Miami move and subsequently moved back. We've had no one come to Dallas and move back. Not one. New York will not empty out. It has competitive advantages. Its legal infrastructure, its concentration of talent and technology and media and law, its cultural density, its position as the gravitational center of global deal-making that no Sunbelt city can replicate in a decade. The AI boom is currently filling Manhattan office towers at record rents. Bank of America signed a 20-year lease in Midtown in 2026. The city remains, as its defenders argue, irreplaceable. But irreplaceable is not the same as invincible. The question is not whether New York survives. It will. The question is what percentage of the highest value, most mobile economic activity it retains as the tax burden rises and the alternative ecosystems mature. The top 1% of New York City taxpayers currently pay more than 40% of the city's income taxes. If even a fraction of that population responds to a 17% combined tax rate, the way Ken Griffin responded to 25 bullet holes in his building, by concluding that the calculation no longer works, the fiscal consequences will compound faster than the departure rate suggests. Ken Griffin stood in front of his Chicago building, looked at those bullet holes, and decided he had seen enough. He moved to a city that was building a $1 billion waterfront tower for him, in a state with no income tax, in a neighborhood where office rents had tripled in 5 years because the demand would not stop. The question Wall Street is now asking, quietly, in conference rooms in Midtown and on waterfront terraces in Brickell, is not whether others will follow. It is how many already have and who has not yet announced it.